Thank you very much, Roland. Good evening, everyone. Thank you for making time available this evening. Can I begin by asking you a question? Has anyone ever heard of Impact Healthcare? Oh, about 6. That's exactly the answer I was hoping for, because we are, as a business, we are just over 2 years old. We're listed on the main market cap around 300 million. And we think sensible people like you, who are good investors, have never heard of us. So it's still all to play for. We're still at early days of building our investor base. Well, hopefully doing that. So we are a REIT. I assume everyone here is familiar with what that stands for, Real Estate Investment Trust. So we're a closed-end company. We can only invest in real estate in the UK, but is related to healthcare. So healthcare is roughly 10% of UK GDP. The NHS is about 7.5%, 8%, private healthcare about 2%. Today, nearly all, so we're talking about healthcare provision, not curing cancer, not pharmaceuticals, all that clever stuff. We're talking about actually providing healthcare. Today, most forms of healthcare require real estate. So there's a huge opportunity out there. We think, and our target is to give our investors attractive returns which are not directly correlated to the wider economy. So consumer spending might go up and down. Exciting things might happen in automotive. Healthcare is not volatile. Our tenants are providing an essential service, demand for which is not linked to exciting things happening in Brussels or not happening in Brussels. The key task we set ourselves when we launched in March 17 was to give our shareholders an attractive level of income. We do that by paying a quarterly dividend. We've done that from our Q1. So in the first 2 years, we paid 1.5p a quarter, 6p a year. So far, we've delivered £24 million back to our shareholders in actual money. I mean, 1.5p doesn't sound like much. 24 million, realize we're starting to talk about real money. And as I used to run money for a large Californian pension plan, and a board member once said to me, look, son, IRRs don't pay pensions, dollars do. So cash is what we are aiming to deliver back to our shareholders. And our aim is to progressively, but also conservatively, in the sense of making sure it's sustainable, increase the dividend. So we announced at the beginning of this year a new progressive dividend policy. We'll grow the dividend each year in line with the rent increases we've received. So our target this year is to pay a dividend of 6.17p. As I mentioned, we are listed on the main market. Our market cap is roughly 320 million at the moment. We have a very strong board. I've just got off a phone call with the board who gave me a hard time, which is good. So we think we will not fall into the trap that certain open-ended funds might be falling into. We have strong governance. And we, the team, are very aligned with shareholders. We've invested just over £11 million of our own money into the business. We are very aligned with our shareholders. We do well, they do well, and vice versa. So far, we're only using a small piece of our investment mandate. We've decided to focus on elderly care. I'll come back to why we think that's interesting. Rather than buying hospitals or doctor surgeries, dentist surgeries, will all be very interesting, but we decided as a young business, we want to keep our strategy focused and relatively simple. So at the moment, we own 83 care homes spread around the country, roughly 4,000 beds. Our rent is £21.5 million a year. We have very long leases, and we have 8 tenants. Our latest tenant is the NHS, and we're keen to do more business with the NHS and help them potentially solve some of their problems. Last year, 2018, was our first full year as a business. So our year end is December 31. This is the first full 12 months. I won't read out all these numbers to you. There's a lot to absorb on this slide, but we're very happy with how our first full year went. So we increased our portfolio by just over 2/5 the size of our business, our portfolio. More importantly, we increased the rent we're receiving by almost 60%. So I think that shows that we're not just growing for the sake of growth because we're managers and we like growing a business and it's very exciting. We want to make sure what we're doing is accretive for our shareholders, and we think we can demonstrate that we are buying assets which will increase returns rather than reduce them. I've already mentioned to you the progressive dividend policy. Those of you who have invested in REITs before will understand that dividend cover is extremely important. You can only pay out cash if you're receiving more cash than you're paying out. Some REITs don't do that. They pay money they haven't yet received. Our dividends were fully covered by earnings per share last year, and we want to keep it that way. I'm going to come back to capital growth and how we think we can deliver that and what tools we can use to deliver some capital growth on top of the income. But while we're doing all this, we're very keen to have a very conservative balance sheet. So with real estate, obviously, you can borrow lots of money. Debt is very cheap at the moment. We've deliberately said the maximum loan to value, maximum amount of debt we can have on our balance sheet is 35% of our assets. At the year end, we had 12% drawn debt against our assets. So we have very low levels of gearing for a property company. There are two reasons for that. One is we can pay the dividend without relying on too much debt. And two is, many of you will know, care homes in the UK have had a checkered history. If you want to, we can discuss that later if anyone wants to get into detail. Simple reason for that is some of the big chains, because they were such stable, attractive businesses, private equity bought them, jammed in as much debt as they could, and then surprise, surprise, Four Seasons and other care home chains have gone bust. The simple reason why it's happened is too much debt. So we want to make sure we and our tenants have no risk of that happening to us. So we're going to keep our balance sheet very conservative. We cannot go above 35% LTV without going back to our shareholders and getting their consent to that, and we have no intention of doing that, of seeking that consent. We've had a busy year so far this year. We've been making acquisitions as well. I didn't put the acquisitions on this slide because it would have got far too busy. So we paid our Q4 dividend for 2018 in January. We announced a placing program to raise another £200 million, and we moved from the specialised fund segment of the main market to premium listing in February. We put another loan facility on, which we haven't drawn, but it's available to make acquisitions. We paid our first dividend at the higher rate of at 6.17 divided by 4 in May, and we placed some new equity in May at 106 a share. That's a 2p premium to NAV and was about a 2p discount to the share price when we did it. After that, we then went into the indices for the first time. So we're in the FTSE All Share, the FTSE Small Cap, and the main property index. Our shares then did some interesting things a couple of weeks ago as we were in the indices. They went up to 115 and now around 110. 108 bid, 110 offered. So why do we do what we do? We think it's quite unusual to see a market where the demand and supply dynamics, the fundamentals, are quite so out of line. So demand is going to grow for good quality elderly care. The key demographic are people over 85, and the number of people in this country over 85 is going to double in the next 20 years. Now, there's a small bit of variability there, but we're not talking about immigration. These people already live in the country. Life expectancy has declined very slightly, but it's pretty stable. Yeah, this is going to happen in terms of increase in demand. And roughly, if you look at the last 40 years, about 15% of people over 85 need some kind of care which is very difficult to provide at home. So obviously, everyone's aim is to stay at home, have a good quality of life, and die in their own bed. That's what we all want to do. For roughly 15% of the population, for the last 2-3 years of life, that just isn't possible. They need the kind of care they can only get in a residential setting, either a care home or a hospital. Supply over the last 20 years has shrunk by 17%, the number of beds available in the country. There's a whole series of things going on there. We can discuss those at some length, but supply recently, in the last couple of years, has stabilized, so it's no longer shrinking, but it's not doing anything to meet that rising demand at the moment. And that means it's a very interesting market, we think, to invest in. If you look at who is operating these facilities, so it's overwhelmingly a private market. The government has largely withdrawn from owning and operating its own care homes, unlike hospitals. These are mostly private sector operators. The dark red line down the bottom are private sector for-profit operators. The orange bar are charities, not for profit. They provide between them over 90% of the care beds available in the country. And what you'll see there is their revenues have been going up at roughly 4% a year. This is the longest time series of data we can find over the last 13 years. So there was a major recession in 2008, 2009. You cannot see that in their revenues. And that's because they're providing an essential service. It's not correlated to other things going on in the economy. And today, in terms of who pays for care, it's pretty evenly split. So about 45% of the market is paid for by families, About 45% is paid for by a combination of local councils and the NHS. And then there's a growing top-up market where the council says that we can afford to pay £550 a week. The care operator says, I'm sorry, it costs 700, and the family agree to pay 150 on top of that. So it's a mixed economy of public sector and private money. In total in the country, there are 465,000 care beds. So you remember I said we own 4,000 at the moment, so we own less than 1% of the market. It's a very fragmented market. We want to continue growing. If we double or triple in size, we'll be 2% of the market. So there's a long way before we're bidding against ourselves or we run out of things to do. It's a big market. So £17 billion a year gets spent for a combination of private and public money on providing elderly care in a residential setting. And the bit of a market, and the market, of course, is segmented between super prime care homes. So these are brand new care homes in Esher or Ascot. They're very attractive. They're also very expensive. They're very expensive to go and live there, £1,500, £2,000 a week. They're very expensive to buy. Vendors will try and make you pay £350,000 a bed. I'm not criticizing that part of the market, but we think that part of the market is overvalued and underserviced in the sense that if you're paying that much money, you should expect to get absolutely perfect service. And new homes, that's not necessarily the case. We have a deliberate sort of mid-market strategy where we want to buy good quality mid-market homes, preferably in provincial towns. So we really like market towns on the A1, Grantham, Lincoln, towns like that, where there's good combination of housing wealth and people who actually want a job in a care home. Because it's all very well owning a shiny new care home. If you can't find staff who live locally, it will be unstable, it will not provide good service, your tenant will run into difficulties, your rent won't get paid. So you've got to have a combination of customers and staff. So if we can find good quality middle market portfolios on an attractive yield where we're paying land value plus rather than paying a developer a huge profit, and then we can work with our tenant to improve the operations of the home, and we as a landlord are very happy to invest in the home to improve it. I'll give you some examples of that, of how that works in a minute. The leases we put in place are, obviously we're a landlord, we want to make sure we're protected, but also we want to make sure our tenant has clarity of what's expected from them, and our tenant has a good opportunity to make money. We need our tenants to be profitable, make money, because then they'll have a viable long-term business, and they can focus on what they do, which is providing good quality care. So what we tell our tenants is we won't go for a fixed term of less than 20 years. In commercial property terms, this is very long term. We have options to extend those leases, no break clauses, so it's a genuine long-term arrangement. It's a very long-term partnership with our tenants. We insist on an annual inflation linkage in our leases, but we put a floor in of 2%, cap of 4%, so we know our rent's going up at between 2 and 4% per annum. We put the cap in because, I think this is unlikely at the moment, but if inflation did something it took us all by surprise in this room, inflation started roaring away, we don't want to put unnecessary stress and strain on our tenants. They're providing an essential service, it's important they can go on functioning. And if they have a cap on the rent, it's only fair we thought we have a floor as well. And final point, I won't read out all these bullet points. Our homes are in use 24/7, 365 days a year. They get a lot of use, a lot of wear and tear. So the one area we are quite demanding of our tenants is repair and maintenance. We say, you the tenant must pay for repair and maintenance, and we're going to make sure you're doing it. And because as long as they stay on top of that and they're constantly doing things up, improving things, you then walk into one of their homes and think, because everyone walking into a care home thinks it's going to be terrible and quite depressing. If you walk in and think, actually, it's quite nice, you're starting in the right place. Whoops, sorry. So when I said earlier, so we as a landlord like investing in our assets, here's a couple of examples. So Freeland is a 62-bed nursing home we own in Oxfordshire, just outside Witney. That photograph was taken on a really horrible day in February, a really gloomy day. And you can see we put the foundations in the membrane for a 46-bed extension. So the way this works, we don't tell the tenant, build more beds. The tenant has to come to us. In that case, they said, look, we think there's a real shortfall of good quality beds for people with dementia, with advanced dementia in our market. And we said, well, can you prove that? Prove to us there's real demand here, underserved. They did that. Well, they convinced us. And so we said, fine, we will fund building a brand new 46-bed unit, which will be attached to the existing home. It's providing a different service. The existing home is for nursing. The extension will be for dementia. We expect to open that, well, we'll finish, the builders will be off-site before Christmas. The regulator, the CQC, will then have to come in and inspect it. It will open in Q1 next year. On the right-hand side is a smaller example we did last year. It's a 21-bed dementia unit attached to a home in Cambridgeshire, outside Ely, which we built last year. And here's a list of the other sort of CapEx projects we're backing. So far we've committed £15 million, which will add a couple of hundred beds to our existing assets. This is probably the single most attractive way we have to deploy money because we make a very attractive return on it. The yield we'll make on this money is over 8%. There's a lot of capital gain upside on here. But also it's a great deal for our tenants. Before and after, they will have more high-quality beds to operate. They'll make more money. And we hope it's going to be a great offering for the people who are going to live in these beds. They're going to be brand new, high-quality beds. So in our mind, this is a win-win. We'd love to do more of this, but it's a bit like a snowball. As you know, you've all done building work at home. You know what it's like. It's difficult. You get the builders in, things overrun. For one in Oxfordshire, we were 3-4 months late because we had a newt problem. There's a little pond to the right, and someone found some newts there, and we had to build a bridge so they could go and live somewhere else. And newts. So yeah, there's a lot of project management here. It ranged from some quite big projects to some very small things, but we're trying to find ways of doing more than that. And assuming we're successful in doing that, this is how our target. You're going to hear some more exciting things, I think, about oil and gas and other things where you can make some real money. Our job is to be as boring as possible. And if by doing that, we want to make our shareholders, our target is a total return of 9% per annum. So 2/3 of income. And our core investors, Schroeder Casino, Bailey Gifford, Quilter, if we don't pay most dividends, we're in real trouble. So we've got to pay the dividends. If we're getting the rent increases from our existing tenants, then a chunk of that rent increase will go into our value. Because if the rent's gone up, you keep the yield the same, the value should go up. And then the kind of asset management I was just talking about, if we keep going, we're delivering 100+ beds a year, that could be about 1% capital growth. So what we're not relying on here is playing around with yields, saying we bought something with 7% yield, and because we're very clever, we're now valuing it at 6%. We're keeping our yields flat, and we're not relying on just putting in more debt to drive down our cost of capital to create return. These, in our minds, these are genuine returns, it's organic, and we hope they're going to be deliverable over a long time period. So again, to repeat Rowan's words, no promises. Things go up and down. There might be years when we make an 8% total return. There might be years when we do 10%. But this is the target we set ourselves. And if you have time to look at our annual report, we've said in our annual report very clearly, here are our KPIs. Here's what we're trying to do. Have we done them? So we want to make sure our shareholders can look at that and say, are these guys doing what they said they're going to do? And if we don't, they won't be very happy. And I will read out every word of this. It's very important.
There we are.
Thank you.
Andrew, thank you very much indeed. Okay, as a reminder, if you have a question, please raise your hand and wait for my colleagues Peter or Chris. The gentleman here, please, Peter, ahead of you. Thank you.
Howard Christensen, I take your point that you are addressing a small percentage of the total market, but there are a lot of retail companies at the moment who are negotiating rent reductions with their landlords. Now, with the reduced council financing and the increased minimum wage that we've seen over the last few years, how do you think that might affect your future profits?
There's a lot of questions in there. I'll try. If I'm going a bit fast, I apologise. I'll try and. So, first one, what we are looking for on day one, so when a tenant comes to us and says, let's do business, the first thing we do is say, let's forget the numbers, let's get in the car and go and look at what you do. We've got to get comfortable, they know what they're doing, they know how to provide care. If that is good, second question is, do you know how to make money? So show us what you're making today. Don't show us some future, it's all going to be great in 3 years' time. What's actually happening today? And then normally we're looking for rent cover between 1.8 and 2 times. So we say if your EBITDA's $1 million, let's make the rent 500, maybe 520. So the tenant is making $500,000, we're getting $500,000 rent. So it's very important the tenant is making real money from day one. And we're looking for a business plan showing that the rent cover will increase. Our tenant is going to make more money, not less. And we have a risk of actually being under-rented. And it will be, I had a discussion with our board about this afternoon. They're saying, well, why are we agreeing such a low level rent with tenant? We should get more. I said, no, we want to be under-rented. We want our tenants to do really well, because then we have security. The minimum wage, this might sound very odd, has been good for some of our tenants, because when you sit down with a customer, so local authority, a commissioner from local authority, what they're very good at, you say, look, I have to have this many staff. You can't be you have to have you have to have staff rotas, you have to have this many carers, this many nurses on time, all times of day. So the staff aren't optional. And you sit down with local authority and say, this is what it costs me. So I need to charge you this to pay for that, and the minimum wage is going up at 6.1%, my overall wage bill is going up at 4.7%, you've got to pay for that. They get that. They're really good at that. What they're really bad at is when you say, well, I've got this much capital deployed, and I need to make a return on capital, it just doesn't mean anything. So the minimum wage is actually, if you look at what's been happening to fees paid, going back to that revenue side, they've been going up, revenues are operating up above inflation for the last 13, 14 years. So then you say, well, how come I read in The Guardian every day there's this major crisis in adult social care? In that crisis, there is a genuine problem. There's a really big problem. That the government's been, austerity meant cutting back on local authority funding. Local authorities are really short of money. But the adult social care budget pays for everything, from a young adult with learning disabilities through to an elderly person living in a home. And that's, I think, one of the main reasons why supply hasn't been rising in line with demand, because when the government says, fine, I'm going to pay for your mother to go and live in this home, and I'll pay the going rate, the operator's fine, you'll make money. But then they'll find whatever excuse they can not to put someone else in a home. They'll delay doing it. And what's been happening increasingly is that person ends up in a hospital bed, which costs 3, 4, 5 times more than a care bed. And then you've got this enormous bed blocking problem in the NHS. So I think the government's kind of worked out, trying to save money by not giving care, you create a much bigger problem. Will they fix it? I'm not sure. But if in the meantime, if you own a good quality care home, you provide good quality care, you charge, we don't want to be the most expensive operator. We want to charge good value fees where you're not gouging people. You can be pretty sure you'll be 94, 95% full, and you should be making a margin of 25 to 30% on that. That's what a good tenant looks like.
Other questions, please? I've got a couple. Gentlemen here, wait, we don't mind waiting for the microphone.
A couple of things. From it seems that expanding is a good thing. Or, individual homes, do you look for homes that have got room for expansion when you're buying one? Space that you can build extra places?
It's not essential. We will buy a home, it's tight on its site, it's nice to be done. Yes. But it's quite important. So we like sort of where there's potential to do something, and where the tenant is. We want tenants who are ambitious and they're thinking not just, oh, well, here it is, I'll just turn up every day and operate the home. What can I do better? How can I grow and improve what I'm doing? That's the kind of people we want to work with.
And are hospices part of the tenants or not?
No. We've kept it really, really simple and focused. We'll come to a point where we get to a certain size and think we can't diversify, but should we look at other things? Healthcare only. But so far, we've kept it very focused.
Could you talk a bit about the profile of your tenants?
So that's the gating issue on our growth. That's the thing that means we're not growing faster. Well, minor detail of access, raising more money. But the money's always there for a good deal. Is finding good quality tenants. So most of our tenants, all of them are private companies. None of them are PLCs, none of them are quoted companies. They're owner-operated, and we spend a lot of time getting to know them. So there's a tenant we hope to do. I got board approval this evening to do a deal. We spent 2 years with that tenant looking at various things to do with them. We finally got there, and we got to know them really well. And as a group, one thing at the moment, well, the NHS is different, the NHS is different, but the other privately owned care operators, none of them today has any bank debt. Obviously, we're not saying to our tenants, you can't borrow money, but we really like tenants who run a very conservative business model.
And do they tend to be single property, or do they have multiple sites?
They
or a
range
combination?
so one of our tenants runs 84 care homes around the country, and one has 2. It's a whole range, but the one with 2, our aim is to help him grow he now has 5 with us. We're helping him grow his business.
Okay. And they're private businesses, are they family businesses, or are they...
On the whole, they're family. So the market's incredibly fragmented. The top 5 operators in the country only have 16% of the market. You very rapidly get down to owner-operator with 1, 2, 3 homes. So we think the sweet spot is that if a family what we're doing a lot at the moment is generational planning. So the children come to us saying, I'm taking over for my mum and dad. I'm ambitious and I want to grow this from 10 to 25 homes. That's a conversation we really, really like. That's a really good conversation to have.
And my other question was, the money you raised, there's a 200 million and a 100 million, is that right?
We raised 160 in the IPO, we did a tap issue, 32 million, that's in 2017, and then we raised 100 million in May this year.
So who came in on those?
So the people who have filed their TR1s, who are above the 3% disclosure limit, are Quilter, Schroeder Cazenove, Bailey Gifford, CCLA, that's the Church of England, Premier, and someone very rudely I have forgotten. Someone really important.
And
You're not here, are you? No, good.
I'm about done. I've got one final. Any other questions from anyone else in the room? There's a chance, lady here. Thank you, Chris.
Do you actually build the properties or do you buy them and rent them out?
We don't build from scratch, from ground up. So we've said we cannot do greenfield development. We won't, in our prospectus, we won't do any greenfield development. What we can do is forward fund. So if we've got an existing tenant who says, live example, one of our tenants has come to us and said, look, I've got this nice home in Cheshire on the main high street in Wilmslow. It's full, it's doing really well, but what we need to do is knock it down and replace it with a brand new home. And we said, that sounds pretty cool, let's have a look at it. So if we've got an existing tenant where we can, with that tenant, we've got 27 homes. So we know there's cash flow, they're making money elsewhere. Yeah, it might make sense for us in that case to take that home out of service, knock it down, replace it with a brand new one. But what we're not doing, we're not buying fields and then doing speculative planning applications and thinking, let's build a brand new one. There's too much risk there. I think.
Okay, and my final question then, on those expansion projects that you highlighted, both of those I think were adding dementia care beds. Is there a higher return on higher need patients or elderly people who have higher care, or does it make much difference?
It doesn't make much. To us, it doesn't make any difference. We charge the same amount for our capital. It's up to a tenant to decide what they want to do. We want to see a tenant who's very clear-minded, because these things operate in very... Typically, a care home market is a 15-minute drive time around either where the person who's going home lives or where the child who's going to be looking for the home. It's 50 minutes around someone's house is where you look for a care home. It's a very local market. So a tenant has to understand absolutely what's going on in that micro market and come to us and say, here's the opportunity, here's what's underserved in my micro market at the moment. And we're open-minded. But we have a preference for more acute care rather than... So there's 2 kinds of care. There's residential, which is, as Mahesh would say if he was here, your body works fine, your mind might not be too good. Whereas nursing care, your mind might be fine, but you find it hard to get out of bed. Lots of people investing in residential care in the southeast of England. They're saying it's easy, you don't need nurses, it's much easier, and I can charge lots of money. It's also much more optional. As home care, we think is going to improve. There are lots of tech-enabled home care companies starting to get going, which could enable you to stay at home for longer and have better quality care at home. So there'll be more, we think there'll be more competition, that kind of thing. Whereas if you're doing nursing and dementia, it's an essential service. And the option is, are you in a care home or you're in a hospital? There's no optionality in it.
Lovely.
Unfortunately.
Okay, Andrew, thank you very much indeed. Thank you.
Thank you.